SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner at Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Karl Pierre, who founded Aidbook Holdings and has been on a very compelling journey, starting with his family's own home healthcare agency and growing into a tech-enabled roll-up strategy that he's pursuing today. So Karl, thanks so much for coming on.
Thank you very much for having me, Sean.
Cool. So why don't you give us kind of a background of the family business and how you've been on sort of both the selling side and now more recently on the buying side and the strategy that you're pursuing?
Yeah, the way that I got into this business, which actually started out with medical staffing, was that my mom is a nurse and she was a supervising nurse at a facility, and she saw an invoice from one of these staffing agencies, and she was like, "Wait a second, if this is what they're charging, I might want to get into this business." So back in '96, she started a medical staffing company, and for those of you who are old enough to remember the internet back then and technology back then, there wasn't much available, and people really didn't know their way around computers. And my mom was one of those people. So as being one of the younger kids that was interested in the computer that we had at home, I became her assistant in all aspects of the business. So from onboarding employees to scheduling staff to assisting with invoicing, payroll, everything started from, those teenage years. We later got into the home healthcare space, and I studied health technology and management in college, and everything that I was learning in college, I would apply to the business, and eventually became the lead and CEO of that company, growing it out to over $10 million in annual revenue. And in 2019, we started to get approached by PE firms and a publicly traded home care company that were looking to get into the New York market and started to get offers to purchase our company. And for anybody who owns and operates a company these days, you're going to get at least 3 offers a week from some sort of search fund or someone who's looking to acquire. But in those days, it wasn't common for us to be approached to be offered an opportunity to exit. And that's where I really got a little bit of insight into how private equity works and how publicly traded companies really view and value the assets that they take on, right? Because when you're not inside the space, what happens is you only see like these news articles of, Facebook acquires Instagram for $1 billion. And it's like, wow, how does this all happen? Or you've seen movies about M&A, but you don't really understand what's really at play. So when we started to entertain these offers, I really got the sense that we've been growing our business all wrong, right? Because we were bootstrapped to the T, doing everything organically, marketing organically, never paying for ads, just this nurse-owned and family-run business. And it made me realize that there are other ways to add value more aggressively, faster, and even help me understand how multiple growth occurs. None of these things were kind of in my privy. I had no idea how
Sure.
any of this worked. But in having the conversations and probing and asking and trying to understand why they're buying, it made me realize that there's really some opportunity out here. And another thing that I thought was quite fascinating was that whenever I was across the table from, I guess, the initial searcher or the analyst on the other side, they didn't really know the business. They just one had a mandate to acquire $200 million of home care revenue that year. That was the goal.
Right.
So anything 10 million and above was of interest to them. And as I was trying to go into the kind of the nitty gritty of how we operate, what we do that's a little bit different, uh, it was almost like I was talking to someone that was completely speaking a different language to me, completely foreign to the business. All they really cared about was patient count, top line revenue, case mix. None of the other nuances mattered to them. And I was like, man, if these are the people who are responsible for making the decision to potentially move forward, I might have a competitive advantage because I've grown up in this business. So if I could learn the other side of this, then I think I would have quite a bit of value and somewhat of a competitive advantage if this is who I'm competing against.
Yeah, it's pretty neat. And also, there's some real nuggets in there about what likely many owners are experiencing when they get these types of offers and when they're running their own businesses day to day, right? There isn't this mindset of, hey, we can go grow our business by buying companies for 3 times their earnings. And then, if we get our business to 5 million in earnings or more, we actually are worth more like 7 times our earnings. So there's just this inherent, multiple arbitrage or multiple expansion, as folks call it, built in. That's not really a concept to a lot of folks. And like you said, that can be a competitive advantage if you know the business, which a lot of the folks going after the multiple expansion and these kind of theses aren't going to know these, the nuances and the tactics of these businesses as well as you and your family did, Karl. So I think that's a great, nugget of information for folks that are on either side of the table. It's worthwhile to, beef up your skill sets on both sides as best you can. And maybe, that's a good kind of segue into why don't you tell us more about the strategy you're now pursuing now that you've kind of, had that overarching
Aha
view.
moment.
Yeah. Yeah.
Yeah.
Right. Well, what did that cause you to do now? And what's the strategy?
Right. So our strategy at this point is really just to grow through acquisition. And knowing that I can take a company that has a valuation that's 4 times earnings and combine them with 2 or 3 others, and all of a sudden I've added 50% value to that company just by combining them, consolidating the books, and streamlining things. When you're talking into the millions of dollars of enterprise value, that is substantial. And there's not too many investments that you can make with that level of predictability just out there. So what's changed for me is really just looking at it from that lens. Like, well, if I can find other home care operators with a similar profile to my family and to my mom, nurse owned, not that savvy when it comes to technology, kind of running things just by the book, in a standard fashion, get more clients, make more money sort of mentality. If I can zero in on that audience that's looking to retire, looking to move south, looking to, a lot, especially in New York, a lot of the operators and owners are kind of like first generation immigrants. So they always have this vision of going back home, going back to their native country. And if they could go back with a few $1,000,000, they really made it. So our focus is really to work alongside these sort of agencies that have these legacy owners that are ready to retire. Usually don't have a child like me working in the business. But really want to hand off to someone who understands the space. That tends to be a top concern. It's like, well, we've been caring for these clients for such a long time. Many of them we know intimately. Sometimes they're friends, sometimes they're family members who are now under care, and they want to make sure that they're kind of passing off to their company to someone who understands the space. So our rule strategy is quite simple: standard roll up, looking for agencies between at least $5 million in top line revenue to about $25 million in top line revenue. That tends to be the sweet spot where we could still get them at like 3.5 to 5 times earnings in that range. And we're looking for companies that either have synergies in payer mix, because in most states, you're going to most likely going to anchor with one agency and then add on through asset purchases. So just because of licensing laws. So you want to make sure that there's alignment amongst the insurers that the patients have, or there's some strategic services or strategic insurers that you do not have in company A, right? So if company A is servicing the top 10 insurers in the state, you want to make sure that company B either has the same exact insurance, so it's an easy kind of transition where you're kind of pursuing a closure plan, you're closing one agency and discharging the clients to agency A. So those things need to line up because you're going to get a lot of friction otherwise, or you're going to have to do it as a stock purchase. Or the other thing that you want to really look at is true diversity in services. Uh, what we've focused on predominantly has been long-term care. And now we're looking to get into infusion, treat, uh, private duty and infusion therapy. Those lines of business are quite interesting to us because one, we've never been exposed to it. We haven't built relationships. We haven't built referral sources. We don't have the contract for it. We actually don't fully know how that business operates. So being able to strategically acquire an agency in our territory that has services that are kind of new to us that we believe we could expand on is obviously something of interest to us. And the goal is really just to consolidate to larger top line revenue numbers and really force to multiple up.
It's really cool that you've taken what you learned from going through a process that could have resulted in your family selling the business and said, wait a minute, we can go do that ourselves, right? And that's huge. And one thing that you and I had talked about, in the past that we didn't just mention there is the fact that you're also working on some software and really a tech enablement approach to this as well. And to me, that's also very unique and goes kind of hand in hand with, your overall growth mindset of saying, hey, we've had this successful family owned business for a while, but there's some, new opportunities on the frontier that we can really pursue in organic growth and tech enablement. So I'd love if you could share a little more about the tech enablement piece as well.
Yeah, absolutely. So, like, I guess most things that are created, you kind of create solutions out of your own need. So,
Most useful things that are created, I'll add. There's a lot of things
yeah,
created, but the stuff that ends up getting used, I think that's a fair
yeah,
way to say it.
yeah, created out of true need. So the federal government mandated that all home care services that are receiving federal funds must have electronic visit verification, or what's called EVV, really as a mechanism to better track utilization and also to mitigate fraud. And we were working with a software provider that didn't have a EVV solution, and we were really trying to petition. They do now, but at the time it was so early in like the announcement of the change that we want to get ahead of it. And we approached our software provider and asked them, can we build out this application, a tool that will integrate with your system that would allow us to capture this with a mobile device? Because at that time it was either a telephony system, which is literally the caregivers will call in from a landline at the client's home, punch in their social security number, and that will log their time of arrival, and then they'll do that at the time of departure. And this company was charging 25 cents per a punch in and out. So it was 50 cents per day per an employee. So having a mobile application would affect their ability to charge for this service. So they just weren't responsive. So we built it ourselves. And what ended up happening was that we were running parallel systems, and our staff kept telling us, like, hey, it would be great if you also added this feature and this feature and that feature. And if we can, bring our application tracking onto the system, and if we could bring the full scheduling platform of medical records and everything else. So we ended up building a complete practice management solution that we fully control. We now license it out to other companies. It's called On-Time ITS. We license it out to medical staffing agencies, home care companies, and social adult daycares. And we are now building out an industry agnostic version of it. So for any workforce sort of heavy sort of industry, so think security companies, landscaping companies, where the work is being performed in the field, we will be able to service them because it's basically the same sort of workflow, except stripping out all of the healthcare terminology and healthcare necessities. But what that gives us is a really unique competitive advantage. The competitive advantage is that we can build out our tools to eliminate nuisance work. And in healthcare, there's a lot of nuisance work. There's a lot of paperwork. There's a lot of compliance. And because of that, you need more administrative staff to execute this work. So we've been able to run pretty lean teams, now looking at some sort of AI models that would allow us to have better staffing ratios. For example, we use one scheduler, or what we call a coordinator, for every 80 clients that we have. And I believe that if we create the appropriate workflows, we could probably get that to 1 to 500. So we would be able to dramatically reduce the number of administrative staff, um, while capturing, nationwide data, while understanding best practices, and even being able to identify uh, which companies that are using our platform fall into the range of companies that we may want to acquire. We actually are in talks with one of our clients that own an adult daycare in New York, 71-year-old owner, foreigner, looking to sell. He's built out a pretty good business. He's been on our platform for a few years. He knows that we've been looking to acquire, and he's looking to play ball. So it could also even be a mechanism for driving us new leads. And the best part about it is they're already operating on our systems. So to be able to walk into a shop like that, it's an easy plug and play and adaptation to really fit into our platform.
Yeah. I mean, that's a fantastic flywheel you've got, right? I mean, you built the software to solve your own problems. Naturally, it solves problems for, other folks operating similar businesses to yours. But then you can, being able to use that data and the client base to understand what targets, what clients might be good partners as an acquisition or investment or what have you, and being able to actually act on that. But on top of all that, it's de-risked because their processes, they're using your systems, go in with a lot less concern about, are we going to need to, bring all these things off of pen and paper and go through old filing cabinets to make sure there's no historic billing liabilities or things like that. You've already got that information baked into the platform. It's almost like you're doing diligence on these companies while they're using the software. So that's really neat. How would you say that impacts, your approach to acquiring businesses? And I don't just mean from sourcing the deal, like sourcing an opportunity, but I also mean if you get one of these companies under LOI, for example, are you able to maybe pay slightly more than you believe another company would or what they're worth because you already know I can do these three things and it's going to increase their earnings? Or maybe it's more just an access to information that others wouldn't have. How would you think about the impact on your actual deal-making process?
I think from a deal making perspective, depending on size, right? So there was one agency that I was looking at. They had 2,000 clients, and they were working on they're on a competitor's software, and they're paying $10 per client per month, $250,000 going out the door in software cost. Obviously, I could incorporate those costs. I could cover those costs in our platform or bring it to near zero, and that in itself would create 1 to $1.5 million of additional value just by eliminating software expense. So that's just one kind of point of optimization. If we're able to get those ratios where we can now get AI to kind of fill in and assist our schedulers so that we're having better ratios of one scheduler to 500 clients, then again I'm eliminating 3 to 4 positions or repurposing those 3 to 4 positions into value adding activities. So I think there are some like indirect sort of benefits to layering our technology on these assets, such as cost savings. But I wouldn't say that we're at a point just yet where I could say this is the exact point of optimization that is driving value or giving us the such a huge competitive advantage that would be willing to up pay for an asset. I think I would still try to target typical prices, but I think if looking at a multi-state operation where we're now over 10,000 lives under management or 20,000 lives under management, being able to run the tech stack of those agencies on our platform at cost would be actual significant value add, right? Because of how much money would be saved by not having to pay that to a third party software provider.
That's for sure. I mean, that's a pretty clear one, right? If you've got, if you can take that $10 per person, $10 per client cost per month away, no doubt. And then you multiply that by your EBITDA multiple, right? That's material value that you guys are creating, very quickly. And you could decide, like you said, if it's one of these larger processes that probably you would be going up against private equity firms or strategic buyers. If you really like the asset, you could say, do we have such high conviction in that we'd be willing to bake that into what we're paying for? Nobody wants to pay for synergies, but inherently many of these auction processes, the highest bidder, or the person who overpays the most or the company that overpays the most ends up winning, right? So if you can, pay for those synergies, you might be able to win some of these competitive processes. Not that you want to do that, right? It's more just a example of a competitive advantage you have as a buyer that a purely financial, private equity buyer probably couldn't do because they wouldn't have the conviction necessarily to say, we have this in-house software that we can roll out at cost, and we know the ins and outs of how it works, where it works, and this is a case where that would work. So that's unique. I mean, that's a pretty clear one. And then I love the example of, if you look at the revenue to employee or revenue to service personnel ratios, and you have high conviction that, down the road, as you've gotten more data from this, but you can say, hey, our average is, one coordinator to 500 patients or something like that. And you notice that these guys are operating at, 1 to 50 or 1 to 100. That's another pretty good example. And it gives you conviction that you can grow the business at the very least without needing to make a lot more, hires or increasing OpEx. So I think that's combining that in-house software and combining the tech enablement that you guys have created for your own organization and using it as both a pipeline for acquisition opportunities as well as a synergy mechanism for your add-ons is really interesting. It's unique. Not a lot of owners that we talk to are doing it themselves. Everything that's in the paper is about venture capital firms that are, backing software founders that are starting software companies and then going and doing these AI-enabled roll-ups. Or in our case, folks like us that are investing in small businesses and working with acquirers of small businesses to then roll out those types of strategies. But you see it less from people who have owned businesses for multiple generations and doing it. That's great to hear about. Any stories you want to share about kind of how some of these acquisitions have played out, or just examples of rollouts you've done in these, with the software or stuff like that?
Yeah. So the workflow, I would say, is pretty typical, but I've got some interesting stories, especially about the ones that die, because anybody who's been out there searching or looking to do deals die often. I'm sure you have that experience. There's always some skeleton in the closet. I would say the interesting things, probably the most interesting for me, are walking into agencies like the one that we were looking at. They were doing 80 million in top line revenue, about $8 million net, and they were running out of a storefront under a train line that so nondescript, you would never even imagine that an $80 million company was operating here. And this is a New York based agency, and it was a pretty unique time because there were rumors that one of the key programs was going to get shifted and canceled. So half of their client census was this program. So they had agreed to discount out 50% of that revenue because it was unknown as to when that program was going to be shifted out. And we were the second group to come in to kind of put an offer in and negotiate on this deal. And they had just gone through an extensive kind of due diligence process with another private equity firm. And, once we started going through our due diligence process, the owner was like, okay, here we go again. I don't have this much time to waste because I'm already in contract to do a nursing home acquisition with the proceeds that I'm expecting from this company, right? It's like, I can't wait on this. So they ended up going with one of the larger agencies in New York that was able to cut them a check for 75% of what we were offering. And they got that deal done right away. So what's interesting to me about that, and what's really the kind of core driving principle of our current fund, is that cash is king, and the traditional A structure is actually slowing down really good deals from happening, especially in this space. Because a lot of the owners aren't that sophisticated. They aren't that organized. So if you understand the industry well, you could easily do back of the napkin calculations and say, this is absolutely an agency that I want to buy. Why? 2,000 clients, half of them are on this program. Well, you could have started to train those to become, I'll give you more context so this makes more sense. So there's what's called traditional home care services. And then there are consumer directed services. Under the consumer directed program, the person doesn't have to be certified, right? So as a home care provider, you have to be certified. As a consumer directed caregiver, you don't have to be certified. And you could employ family members and friends and whoever you want because the care is at the direction of the client. So the training to convert someone from a PA to a HHA or PCA is only 56 hours. So you could create you could pay them to go through a structured program, get their certificate, and then opt in to go and choose, have the same caregiver, but choose to go the other route. The benefit, they're more trained, they're more prepared, they learn body mechanics, they learn how to identify when a client's health is declining and take action. There's so many benefits for them getting training. So you could have paid to train them and kept those clients, right? Because the transition date wasn't announced. To add a little more, a little more to this story, from that time till the actual transition happened was more than 2 years. So imagine getting $40 million of business for free for 2 years and having 2 years to make your adjustments. So the company that ended up buying them is a much larger, one of the largest home care providers in New York City. And it was a no-brainer for them. It was like, we're getting this at such a discount. There's nothing that I need to know other than what's the patient list, what are the average hours, and let's get this deal done. So if I had the same check writing capacity to have made that decision and not have to kind of get the approval of a lender and then get the approval of the LPs to move forward, that would have been a slam dunk, absolute slam dunk, and would have changed our platform altogether. So those sort of deals exist. And I think if you were to have an equity focused fund and an equity focused thesis, you'd be able to get a whole lot more deals done across the line and really like add value at a tremendous rate. And that's kind of the thesis that we're going on now. But these are the space in New York, for example, and this is why our platform is concentrated in New York as our first tranche. There's an estimated $20 to $30 billion worth of home care business in the state. And this is government paid. So being able to build out a book of 50, 70, 75 million, 80 million in business in just that territory is totally doable. The same gentleman who sold for 80 million, he doesn't have a non-compete. He's already back to $40 million in revenue. He's already back to $40 million in revenue. Absolutely good for him. Because once you understand the mechanism of adding clients in that territory, the clients are there. The city is dense enough, and the need for services is kind of compounding at this point.
Very cool. Yeah, it definitely goes along with what I've seen consistently in more, structured acquisition processes like auctions or things of that nature. Certainly the highest bidder, the highest multiple is most attractive, but in many cases, conviction to close and ability to pay most of that cash at close is oftentimes, call it a prerequisite to coming in with a higher multiple. And I think you saw that firsthand, right? You might have been willing to pay more, but at the end of the day, this seller needed cash quickly, and he had a high conviction that this large home health agency that probably has a track record of closing acquisitions historically would be able to close in 30 to 60 days. So, that's a good example of that concept playing out. Any kind of closing thoughts you want to share before we close out here?
Yeah, absolutely. I think, actually I have some questions for you, right? As someone in the space, the deal structure oftentimes can be the pushback point from sellers, right? Especially when you're doing smaller deals, right? So if somebody's walking away with, $20 million, $15 million of it is coming in cash at closing, and the rest is, roll over and sell. No, it's way different than $2 million purchase price and walking away with 1.4 and 600,000 being tied up. In your experience, have you seen a lot of deals die for you or your searchers just based on structure alone? What do you think is preventing or Or do you see the industry shifting at all to having a more equity biased sort of approach? Because that's the approach that we're going with. And I know at times when we're talking to potential LPs, they would prefer a more leveraged leaning approach. And for that reason, they would be out. But I just wanted to get your point of view from your experience and what you've seen. What are you seeing? And sort of what has your experience been?
Yeah, I would say, every so often when we talk to either brokers or, sellers directly, which we do some of, obviously we do, the bulk of our conversations are with buyers directly, but when we do talk to sellers and brokers, we certainly hear I would say a talk track around, yeah, we have a strong preference if you can, go either equity only or have, most of the cash available at closing, meaning kind of two things. One, that you don't need to either go get debt from a bank and that you're not going to ask for a big kind of contingent or deferred consideration piece of the deal structure. So there's that. But I do think that because private equity has come further down market, middle market P funds, lower middle market P funds have come down kind of below that $5 million EBITDA mark, which was for a while sort of the, I would say, unofficial threshold for a platform or something similar. There's probably, I think folks are getting more savvy to the fact that there's buyers out there that can do what you described, right? Which is just say, hey, if we get a good enough deal, we can pay cash at close and get this done in 30 days. And I do think that's very important, especially to non-seller stakeholders like brokers or intermediaries that are getting paid a transaction fee only, a success fee only if the deal actually closes. For them, it's most important that something actually closes, right? And that this just doesn't sit on their listings website or sit in the kind of auction circuit into perpetuity. Whether or not it's been increasing in velocity, that's probably hard for me to comment on. We have seen a few search deals and independent sponsor deals more recently that are structuring the capitalization, kind of like what you and I talked about, where you may try to raise a decent amount of equity up front and then potentially use debt down the road to lever into future acquisitions, which I think can be a really powerful approach. Not only does it de-risk the additional or the initial acquisition to some degree from a credit standpoint, but it allows you to kind of have a bit more control in reaching a target capital structure for the overall platform. Now, we haven't participated in a deal that's done that yet. Not because we wouldn't, but just we haven't kind of seen one come together that checks all the boxes essentially. And part of me wonders how feasible, especially at the smaller end of the spectrum, if you start with a $1 million EBITDA business and you capitalize it with equity, investor returns might not look incredibly exciting on a standalone basis, but if you give credit for, a few add-ons that then get into the debt, it looks more exciting. But how many lenders are really willing to lend, on $1 million of EBITDA and gradually get into a position? It probably takes pretty good relationships, a track record of doing something similar. And then on the investor side, conviction that you're going to be able to execute on a pipeline of deal flow. So I would imagine if you have all those things lined up, the approach could work. But yeah, I think there is definitely deals out there that are taking that approach.
And I guess other question for you is when you're looking at like what spaces get you really excited, and what are the sort of deals that you can't wait to sink your teeth into?
Yeah, there's a few dynamics, and we had a guest on this podcast a few episodes ago. Her name is Lisa Piercy, and I think she emphasized the point that buyers who have great industry expertise and really understand the ins and outs of the businesses they're going after do have a competitive advantage. I think that's a really strong point, and you're sort of saying a similar thing without saying those words exactly. You're saying what you said earlier in the call was you talked to folks at private equity firms that wanted to buy your business and might not have known the nuances about it, right? And that's going to give you a competitive advantage, and also ultimately, in some way, led to building out the software that you did because you saw those problems and those nuances and you built out that solution for yourself, which has now become a competitive advantage itself. So we do like seeing that kind of industry expertise, or kind of a local market expertise can also be interesting if you're very entrenched and involved in the local market and you're looking for a business that has, strong local economies of scale dynamics. I think those things are always great to see in an acquirer for a team. But from a business model standpoint and a strategy standpoint, the types of things you're talking about are very compelling, right? I mean, how do you create value for a business that gives you a sustainable competitive advantage? If you've already done some of that, which you have, great. So as an investor, we're kind of getting in to something that already has a unique competitive advantage rather than needing to bank on the build out of that competitive advantage. And how do you, drive growth in a credible way, which again, I think you're honing in on the right concepts, which is, you've got this tech enablement approach, you've got the inorganic growth play and you've seen both of these play out within your industry where you have expertise already. So, those sorts of things, I would say, take a business that meets your classic search fund criteria of recurring revenue, low customer concentration, non-cyclical, those sorts of things. And it takes that and turns it into, okay, this is something that could be a real home run. And that's, I would say, what gets us really excited. But look, I appreciate you flipping the script and interviewing me a bit. And yeah, Karl, thanks so much for joining. This has been great.
Not a problem. Thanks for having me. Appreciate it.